So hello, welcome to the first lesson. So in this lesson, we will learn about the financial accounting, the conceptual framework of accounting, and the cash basis and accrual basis of accounting. So the first thing first, so the financial accounting is the field of accounting. So the concern with the summary analysis and reporting of financial transactions relating to a business. Okay, so the financial accounting consists of three basic activities. The first one is identification, whether an event is economic or non-economic, and the second one is the recording, meaning we will record the journal entries, post to the ledger, prepare trial balance, then the preparing the financial statements, and finally we will communicate our financial statement, meaning our findings through the financial statements, the income statement, balance sheet, owner's equity statements. Okay, and there are two groups of users of the financial reporting. The first one is the internal users. So, who are the internal users? So, the internal users of the accounting information are managers who plan, organize, and run the business. And they are the marketing managers, so the production managers, financial directors, and the company officers. And there are external users, and uh, they are the people who are from outside the organization and who want the financial information about the company. I mean, they have some vested interest about the company. And the two common external users are investors and creditors. Okay, and others are analysts, government agencies, tax authorities, customers, labor unions. So the cash versus accrual basis of accounting. So initially, think about 100, 200 years uh, before. So the people were recording their transactions only when they receive money or only when they pay the money. Okay, so that is actually under the cash basis of accounting. But this cash basis of accounting is not supported by generally accepted accounting principle gap. Okay, but still there are some applications of cash basis of accounting who do not believe in the accrual basis of accounting. And what is that? So the companies record revenue only when they receive cash and record expenses only when they pay in cash. Okay, so the difference between the cash received and cash payment is net operating cash flows. So accrual basis uh, accounting record the revenue when they complete the service performance or the delivery of goods. So they recognize expenses when incurred irrespective of cash payments. Okay, and let's see an example. So for example, the company paid 60,000 for 3 years rent. Okay, beginning year one. So under the cash basis accounting, the rent payment will be recorded as, see that. So we have paid rent on year one. How much? 60,000. But we have paid for year one, two, and three. But see, we can see that we have recorded only in year one, meaning it indicates that we didn't uh, have any expenses for year two and three. This is cash basis. It means that we are recording expenses only when we pay. Okay, in this year two and three, we didn't pay. It means that we don't have any expenses. But this is not correct, right? So this is how it is done under the cash basis of accounting. Okay, and let's go to the accrual basis of accounting. So for the same transaction, so if we go to the accrual basis of accounting, we can see that so for year one, two, and three, we have split the 60,000 into 3 years over the 3 years. Okay, 20,000 each year. So this is the basic difference between the accrual basis and cash basis of accounting. Okay. And but the net result is same. See, you can see that the total at the end of the third year. So the total impact is 60,000. So 60,000. Okay. Now, what is GAAP, FASB, and IFRS? So the accounting profession has developed standards that are generally accepted and universally practiced. These common set of standards are called the generally accepted accounting principles, GAAP. And the primary accounting standard setting body in the United States is the Financial Accounting Standards Board, that is FASB. And the Securities and Exchange Commission, SEC, is the agency of the US government that oversees the US financial markets and accounting standard setting bodies. So the countries outside the US have adopted International Accounting Standards, IAS. These standards are called International Financial Reporting Standards, IFRS. So the conceptual framework of accounting, what does it mean? See that? So, every profession, every nation, they have a constitution. So accounting also has a constitution, which is the conceptual framework of accounting. It is described as an accounting constitution. So the conceptual framework sets out the fundamental concepts for the financial reporting. So that actually guide the board in developing IFRS standards. Okay, and the conceptual framework also assists companies in developing accounting policies when no IFRS standard applies to a particular transaction. So, and helps stakeholders to understand and interpret the standards. Okay, and the history of conceptual framework of accounting. So, as we can see, April 1989. So the framework for the preparation and presentation of financial statements was approved by the IASC board, and the framework was published in July of 1989. And then in 2001, the framework was adopted by IASB. However, there were some limitations and there were some changes after 2001. So we know many things have changed. And then after 2002, actually, so the ISB and FASB, they started their convergent project. So from that, they have developed a new conceptual framework, and the name was the Conceptual Framework of Financial Reporting. You can see that this is for the financial reporting, but this one was financial statements. Okay, so there are some differences, and it was approved by the ISB in 2010. And 2018, the Conceptual Framework for Financial Reporting was published. Okay, and let's see the difference between the 1989 and 2018. So the 1989, it was actually focusing on the financial statements, and they were the income statement, meaning how to present the income statement, balance sheet, cash flow statement, and statement of changes in equity. But in the 2018 framework, so the main focus was financial reporting. See that this was financial statements and this one is financial reporting. That is why we are saying annual report, so the quarterly report and conference calls, okay, and the financial notes. So conceptual framework concluded, so the objective, the first one is the objective, then qualitative characteristics, elements, recognition, measurement, the constraint, and financial statements. There are many things, so we will be discussing. And now let's see, we can see the objective of the general purpose financial reporting, the qualitative characteristics of the useful financial information, the number 4. So we will explain each of them. Let's see. So the first one, the objective of the general purpose financial reporting. So the first one is the main objective is to provide information about a reporting entity's economic resources, claims to those resources. Why are you saying, if we write, assets equal to liabilities plus, owners uh, equity, right? So, meaning we are saying that to provide information about the reporting entity's economic resources, meaning assets, claims to those resources. There are two claims, one from the owners and another one from the liabilities, meaning the creditors, and changes in the resources and claims, meaning what are the changes in assets, liabilities, and owner's equity. Okay, and so to provide the financial information about the companies that is useful to the capital providers in making decisions. And investors decide whether to buy, sell, and hold equity or debt securities, and the creditors decide whether to provide or settle loans. And to provide information that is useful to the capital providers, so to help identify strengths and weaknesses and assess the liquidity and solvency of the company. And there is a question, big question. So the question is, so the IFRS framework notes that these reports cannot provide all the information required for economic decisions. Huh? What's the problem? So the problem is there are also other sources that can also affect uh, the investors' decisions. Let's see an example. For example, so think about the August 2018, the news about the divorce of Jeff Bezos and McKinsey. Okay, so they announced their divorce in August 2018, and let's see what was the impact. So as we can see, this is the Amazon's stock price. Okay, so Amazon. Okay, Amazon. Okay, stock price. So we can see that this was going up, right? Okay, and this is August. See, this is August, and at this time, so the news came that they are going to be separated. And see that after that line goes down. Can you see that? It means that this is not the financial information. This is not the income statement or balance sheet information. This is non-financial information. And this non-financial information is not reported in the income statement or balance sheet, right? Meaning that they are news, divorce news. So look at this point. So immediately after the news, the stock price goes down. Okay, so this is how we have to be careful about the non-financial information as well. And the qualitative characteristics of the useful financial information are, so the first thing, so the relevance, meaning the fundamental characteristics of relevance and faithful representation. And their components are the predictive value, confirmatory value, materiality, completeness, neutrality, free from error, and the enhancing characteristics, the comparability, verifiability, timeliness, understandability. Okay, and so the fundamental quality, the relevance and faithful representation, and to be relevant, so the information must have the predictive value, confirmatory value, and materiality. And let's see an example. So the to be relevant information must make a difference in the decision process, and they must be they must have the predictive value. It means that it will help the users to predict a company's future cash flows. Confirmatory value, it means that it helps the investors to confirm or change the prior decision or assessment. And materiality information should be material if it has if it has to have an effect on the decision. Okay, so look at this information from the Amazon. So as we can see that 13, 14, 15, 16, and 17, this is the net sales. So we can see the net sales information. Okay, let's see the trend. See that? So the sales trend is going up. Okay, this is going up. Meaning, so if we analyze, say this is going, this is the base, say then going up, is going up. So what is more likely? The next one will also be up. Okay, so this is a trend, meaning it is helping us to predict the future, and it confirms our assessment. So the faithful representation. So the information must be complete, neutral, and free from error. So complete means it includes all the information required. Neutral means information is free from bias, and free from error means information contains no error or omission. Okay. An example, let's see. So if we look at the inventory, so this is the list of the inventory. Can you see any problem over here? Raw materials is an inventory, work in process inventory, finished goods inventory. But how about the accounts receivable? This is not an inventory, right? So this failed the faithful representation. Okay. And enhancing qualitative characteristics, and they are the comparability, verifiability, timeliness, and understandability. So to be comparable, two piece of information must be measured with the same method. Okay. Say for example, a student has taken GMAT exam. Okay, and another one has taken GRE exam. Okay. Now the question is, we cannot judge their performance. Okay, because they have different methods. GMAT and GRE, they have different algorithm to assess candidates, meaning students' uh, uh, performance, right? So, and the verifiability information capable of being checked for accuracy, completeness, and reliability. And we must have the information timely, and the information presented in the financial statement should be understandable. And there are 10 elements, as we know, that assets, liabilities, equity, investments by owners, and the revenue, gains and expenses, losses, and comprehensive income. So I want to tell you two things. So that gains and revenue, they are not same thing, right? So gains are increases in equity from peripheral or incidental transaction of an entity. Think about the sale of asset. The companies don't sell their assets, but if they sell after 10 years, 5 years, so they should calculate the gains or losses. But revenue is normal. Okay. So the basic assumptions. So the four basic assumptions underlie the gap. So the economic entity assumption presumes that economic events, can be identified, especially when an entity with an economic entity. Okay, so the ownership and business are separate from each other. So the business transaction would be separate from the owners. Okay, so if something is bought by the owners for his or her personal use, it should be recorded in owner's account. And if something is purchased for the business, it should be recorded in business account. So they are separate. Okay. And the going concern assumption anticipates that a business entity will continue to operate indefinitely. Okay. If suddenly a company shuts down, it means that it is violating the going concern assumption. So the periodicity assumption allows the life of a company to be divided into artificial time periods to provide timely information. Think about the entire life of a company, unlimited life. But what we do, we divide the entire life into months, 3 months, 6 months, and annual. And we prepare financial statements for these small segments, right? Monthly, 3 months, 4 months, or 6 months, right? So, and the monetary unit used in US financial statements is the US dollar. Okay. So this is not so important. Recognition refers to the process of admitting information into the financial statements, and measurement is the process of associating numerical amounts with the elements. And disclosure refers to the disclosing all the information. And general recognition criteria, definition, measurability, relevance, and reliability. Okay. And the revenue, so we know about this. And the accounting principles, there are 4 principles, basic principles. The historical cost principle, it states that asset and liability measurement should be based on the amount so given or received in exchange transactions. Okay, and the realization principle, revenue should be recognized when the earnings process is virtually complete and the collection is reasonably assured. Revenue is recognized when earned regardless of when cash actually is received. And the matching principle, expenses are recognized in the same reporting period as the related revenues. And the full disclosure principle, any information useful to decision makers should be provided in the financial statements subject to the cost effectiveness constraint. So this is our first lecture, and so I will upload 2 problems so you can practice and so try to solve them, and we will discuss those problems in our next class. Thank you and have a good one.